Hi everyone, this is Houston Trung from thetradingedge.org, and in this presentation I'm going to share with you some recent findings that I've recently found after doing a fairly extensive examination of some major market reversals. So this presentation is about trading those reversals, and I'll be sharing with you some of the findings, the methodology, the assumptions that I used to examine some of history's major market reversals. And I've kind of split the presentation in two. So the first half of the presentation will be focusing on primarily the theory, and that is around the theory of why these market reversals happen, what they look like, sort of the psychology around them, some of the macro factors. And then the second half will really be focusing more on the actual examples and the case studies. We're going to be zooming in on actual price action and focusing on primarily the examination of price action and time and how some of these historical market reversals took place. So let's get started. We have a lot of stuff to cover, so let's launch right into it. So first and foremost, that's a bit of humor to begin things off. Do they ring a bell at the top of markets? And if I have to answer that question, the answer is no. So, fortunately or unfortunately, there is never any clear sign that a market top has occurred until well after the actual top has occurred. In fact, we actually don't know that we're actually sometimes in a major market reversal or just a correction until well underway. By default, the definition of a correction or a big reversal or crash can only be done after the fact, because you only know after you've actually had the losses. So until you've actually sustained the losses, then you can put that category or that label of crash or correction. But before that, you actually don't know that the actual top is in. And that's the challenge in trading. So they don't ring a bell at the top. There isn't any, after the research I've done and what I'll share with you, there usually isn't any one momentous event that culminates in some massive top. In fact, when we look into the history, you'll see that history's big crashes, like the Black Mondays and the Black Tuesdays and so forth, have actually happened well after the top has actually occurred. So I'm not going to steal the thunder of later slides. I'll just leave that out there for now, but just keep that in mind. They don't ring a bell at the top. The next slide here talks a bit about the psychology of top. So we're not going to talk too much other than this slide about the psychology of what's going on, but it's definitely worthwhile to understand this slide. This slide, all credit given to, I believe his name is Jake Bernstein, and he wrote a number of really good classics back in the late 80s, early 90s around trading. And this is part of his work. But it does a really good job at helping you understand the general psychology of how tops form. So if we begin on the bottom left-hand side, we have the stage one, and that's typically called accumulation. So typically, the quote-unquote smart money is getting involved here. So this is when ideas are still new, the trade idea is still new, the technology is still new, it's a nascent, stock, whatever it may be. And you have the insiders who are typically accumulating shares early at this place because they're the ones who are actually taking the biggest risks. And so they're actually getting involved when things are very nascent and there isn't a lot of understanding or a lot of popularity in the trade idea yet. Now, once the price starts to climb upwards, that's when retail traders and other regular traders begin to get involved. That's called stage two. And that's, if you get early in the stage, that's kind of the best time to be buying. And that's called the uptrend or markup stage. So they mark it up, and usually the worst time to be buying is somewhere up in the top end of the range. The hard part is, how do you know you're at the top end of the range? That's always the challenge with trading. Then finally, the stage three, you typically call distribution. This is where price begins to fail, either fails to make higher highs or just begins to trade in a sort of range-bound pattern. It cannot lure in any new buyers, and eventually it tips over, basically stopping out any late longs. Anyone who got involved too late, they're going to be the first folks who get stopped out as a trade goes against them. And so this drawdown, markdown, or downtrend stage 4, typically pulls price all the way back to nearly the beginning of that bull market run. So it's not uncommon to look at some of the larger market corrections out there, or market crashes, to see 80+% retracements, 60+% retracements, and this basically tests the mettle, the conviction of anyone who had bought, during the markup phase. Here, they sell it off, and if you come late to the game, you get stopped out, or even if you buy down here, it tests your conviction to see if you really want to hold on to that stock or that instrument, whatever it may be. And then finally, once it bottoms out, we get back into stage 1 again, where it takes some time for the inventory to work itself out, and we go back into the cycle again. All right, so I think this is a really good mental model, whether you use it or not. It's a good mental model to keep. It's a good paradigm to understand. So even when you trade, it's better to have a paradigm like this in your head to help you understand where you are in that cycle. So with that being said, let's talk about the next topic, and let's now talk about what actually causes a major market reversal. So think for a second, what do you think causes a major market reversal? Now, for most of us, when bad things happen, or when catastrophes like market reversals occur, we like to be able to identify a simple narrative or cause, so in the future we can either avoid disaster or at least derive some sort of comfort in that we understood why things happened. We may not have been able to avoid some of these disasters. Certainly, I think all of us have been caught up in some bad trades or in some bad markets where price went against us. But it feels comfortable knowing after the fact that we could at least identify why it happened. But here's the challenge. This is sort of a narrative fallacy, because pointing to one specific, easily identifiable cause is rarely sufficient to describe a major market reversal. Even though it feels comfortable and it feels good narratively, the complexity of our modern financial system doesn't allow for simple answers. So many scientists across different fields like biology, geology, economics really believe that the result of single large events don't come from any one single cause, but rather the unfolding of many smaller events that create an avalanche-like effect. This one particular scientist named Per Bak, who's a physicist, developed a theory called self-organized criticality. And that's just a fancy word for describing just the way that complex systems organize themselves. There is always the potential that there could be these little fingers of instability. Think about, a sand pile as an example. As you pour sand on the sand pile, there'll be different areas in that sand pile that are going to have different strengths and different weaknesses. Now, pour the sand too long, and if that one final grain touches a finger of instability that reaches deep down to the pile, if you just hit it the wrong way, that will cause the pile to tip over. And so it is with many of these systems, like the stock market, that sometimes it just takes that last grain to hit the market at the wrong place to cause it to tip over. So, what causes the avalanche? Well, as I described already, to cause an avalanche, you can shake the mountain, or you can find the right place to drop that snowflake. So, as I just briefly described, here's the big idea. Every avalanche, large or small, starts out the same way. When a single grain falls and makes the pile just too slightly steep at one point, that's when it can tip over. But what makes one avalanche bigger than another really has nothing to do with its original cause, and has nothing to do with some sort of special situation in the pile before it starts. Rather, it's more to do with the fact that it's a complex system. it's perpetually unstable, and it's always in a potentially critical state, and that's what makes it possible for that next grain to trigger an avalanche of any size. So it's a bit disconcerting if this is a new idea, but that's the underlying mechanism of these complex systems. Systems like the stock market, these perpetual motion systems, are so complex nowadays that absolutely no one single individual or entity can control them. And it is these number of entities working together, like traders, like governments, like financial companies, like banks, all these individuals, entities coming together that create this marketplace. And as such, there are many perpetually unstable pillars of instability. And this quote comes from a really good book, and I'll share with you some more resources at the end of today's presentation that I used as a reference for much of the research around market reversals. But this one particular author, Mark Buchanan, has a great book called Ubiquity: Why Catastrophes Happen. We'll wrap up with one final quote, and that's from Mr. George Soros around what causes an avalanche and what causes a major market reversal. And his idea is this: the proximate cause of a panic is never the real cause, any more than that last straw actually breaks the camel's back. And this is the important premise that I'm using to do the research for these market reversals, in that I'm not trying to identify any single point that is going to, that I want to say caused the crash of, of this and this date. The reality is that the system is too complex for easy narratives. And so what I try to do with the researcher here is I've gone into these different major market reversals without a bias. I've tried to be as unbiased as possible, as hard as that is. I've tried to remain as unbiased as possible, and to simply examine the reversals for what they are, reversals that are complex, versus having a premise or an idea of what a reversal should look like, and then trying to fit that premise around the actual reality. So what I've done is I've examined 5 major market reversals: the Wall Street crash of 1929, Black Monday, which happened in 1987, dot-com bubble in 2000, the crash of 2008-2009, and the 2018 bear market. Believe it or not, that downtrend, that selling we had in Q4 of 2018 actually is categorized as a bear market. We'll talk more about that just in a few moments. So I spent some time, reviewed these 5 different market reversals, and what I'm going to do with you in the next few moments is share with you the methodology which I used to examine these different market reversals, some of the assumptions and premises I used going into it, and I've talked about some of those already. And finally, I'll share with you some findings and takeaways before we actually go into the charts themselves. Okay? So first and foremost, the methodology. What is the methodology, and what did I do? First of all, as I just talked about, I chose 5 well-known major market reversals. As I said already, I didn't try to cherry pick these. I didn't try to find the best, quote unquote, best major market reversals that fit my paradigm for what I think reversals should look like. Rather, I just chose 5 well-known ones because I think these are all reversals that people have heard of and that they can relate to in some form or fashion. So just topically interesting. Number 2, I performed my analysis only looking at price action and time. And when I say price action, I'm referring to specifically candlestick patterns. For the most part, I did not try to look for, I'm not using candlesticks. I'm not using patterns necessarily to try to, identify things like, bearish engulfing bars and Japanese candlestick patterns. I'm not using patterns to try to forecast or predict where reversals are going to happen. Instead, I'm just looking at the actual patterns, the actual bars themselves as they played out during those market reversals. So I'm not using technical analysis in some sort of predictive fashion. That means I'm not trying to fit a mold around what I believe should be true. So as an example, I wasn't hunting for, let's say, inverse head and shoulder patterns. So I don't have some sort of preconceived notion that inverse head and shoulder patterns need to exist before a market reversal. I'm going to try to find markets where those things play out. So that wasn't the intention there. Okay. And the second part of the analysis was around the time. So the interest to me was this relationship between price action, so the actual bars themselves, and time, and whether or not there was a significant relationship. And I think you'll be interesting you'll find it interesting to see how some of this stuff plays out in relation to some of the different time scales. We'll get a lot more into that later on. Third, I only examined bearish reversal scenarios. Like I said, I only chose those 5 major market reversals that were to the short side, and it wasn't for any other particular reason than that. I wanted to limit the amount of scenarios. I didn't want to go, we could have done, 5 short and 5 long, but this would have made the work too extensive and would have been made the presentation a bit too long. And finally, I chose the contract and instrument that I felt that was most appropriate for the analysis. So I chose the instrument for analysis that either had the most volume or is most pertinent to the analysis. So for instance, when I performed the analysis on the 1929 crash, the best instrument to pick was the DJI index, and I chose to pick that one because it had the most historical data and had in some other contracts where they had the most volume. Okay, so here's some of the premises before we get into the actual findings. One of the first premises I just want to clear up right away is the difference between a correction and a market reversal. So let's clear up some definitions before we get underway. So I try to stay as objective as possible with regards to those definitions. So I think a fairly popular and well accepted definition is that a correction is anything that is above 10% of a pullback, but less than 20%. Anything greater than a 20% pullback or pullback or selling is considered a major market reversal. We can call that a bear market. So I'm using those two terms. I'm using those two terms in the same way. Okay, so the reason why this is important is because I did define some stats around when an actual bear market began or when a major market reversal began based upon the previous correction. So I want to identify correction first before I actually started the next bull market or the next bull run. Okay. Just some quick stats around that. So interesting slide from Morningstar showing just history's bear markets. So I believe this is on the SPX, but you can see that there are some traits around bull markets and bear markets. So as hard as it is to categorize bull and bear markets, there are some traits, like not categorize, but as hard as it is to actually call them, there are some traits around them. So for instance, you can generally say that bear markets last a lot, the duration is a lot shorter than a bull market. In fact, some bull markets they just keep on going. Again, when I talk about bull bear markets and these corrections, I'm typically in this conversation, I'm talking about the daily time frame. So not an intraday. I'm not talking about intraday trading. I'm talking, the major stock markets and the major indices. We're talking about, on the daily time frame. Okay, so there you have your history. So you have some steep pullbacks in the past. Back end here's a 1929 crash, an 80% plus pullback. It was quite prolonged, 34 months in duration. And then contrast this one with this really short one that happened here in the 1980s. So this is the 1987 crash. corrected close to 30%, but only lasted 3 months. So you do have some disparities with those bear markets. Some of them don't last very long at all. Now look at that last one we just had last year in 2018, right? That thing lasted basically 1 month. We hit 20%. Well, we'll get to the stats later on, but it bottomed very, very quickly. But again, if we were to actually stick with our definitions of a 20% plus sell-off being a bear market, then 2018 at the end of December was a bear market. January was a brand new game. We went back to all-time highs. Well, Q1, went back to all-time highs. Q2, and then we're no longer in that bear market anymore. So, next slide. The next premise. As I've sort of alluded to already, one of the premises that I was leading with is that you can only know whether or not you're in a major reversal after the fact. That's just because of the definitions. As I stated already, because you can only define and categorize and label a reversal, a major one, by the number of losses, or the size of the losses, that means you cannot know until afterwards. Next premise. I think it's a fallacy in trying to overlay narrative onto price action patterns. So I've tried to avoid that particular fallacy by not trying to read into price, meaning I don't have some sort of narrative, some sort of explanation on why I think price is going down, other than that price is going down. Right? So I don't believe that this pattern is telling the stock market to go down, like an inverse head and shoulders or some other, a bearish pattern you may have studied. I don't believe in the predictive nature of technical analysis because it's very subjective. Most of these patterns, there is no proof that they're actually statistically significant, and for the most part, a lot of subjective technical analysis is based more on faith, and it's more about people looking for confirmatory instances where those patterns work. So in this case here, I did not try to use price to explain why the markets went down, or the actual technical analysis, why it caused the markets to go down. I believe that the price simply shows what the market's doing, and that I'm just following the price. So there isn't any meaning, any particular meaning or predictive ability in these price action patterns. Okay, so just to restate, price action I don't believe is predictive, and to assert that that this pattern happened and explains the actual price going down, I think is somewhat of a fallacy. I believe that price is going down, and that's what's reflected in the pattern, not the other way around. I don't believe or subscribe to the belief that it's the pattern that causes the price to go down. Rather, I believe the other side of that, in that price is going down, it looks like that pattern. A small difference in wording, but I think it's very, very important. Next, as I've given the example already, belabored that point, inverse head and shoulders. Finally, the last premise I'll share is around a price action, and this is just a simple way to perhaps give you a primer around what we're going to be talking about, and I'm just using the fundamental building blocks of candlesticks to identify bearish reversals. And there's only one of three ways that price can actually ever go down. And once you understand the components of price action, then it's very clear what these reversals look like. Okay, so the first one is inside bar and down. That means you have an inside bar and then it goes down afterwards. Don't worry, I'm gonna show you some examples in the next chart. Second one, up then down, up bar then down bar. Third, outside bar and then down. And let's get to the actual screenshots, because if you're not familiar with what an inside bar is and what a down bar is or what an outside bar is, this will all become clear with one single picture. So if you look at this particular screenshot, you will see a number of different bars. But first I want to point your attention to the bars that have little blue diamonds above them. Those bars that have blue diamonds above them, like this one and that one and these are all considered inside bars. An inside bar simply is a bar that is inside the previous bar's range, right? That means for an inside bar, the high is lower than the previous bar's high, and the low is higher than the previous bar's low. So it makes it inside the previous bar. This bar here is considered the mother bar, and this would be the inside bar. This next bar here, these bars with the little red diamonds, those are called outside bars, because by definition, the outside bar has a range larger than the previous bar. So you have the high that's higher than the previous bar's high, and you have a low that is lower than the previous bar's low. That's what an outside bar is. So now we have those two definitions out of the way. I'll just quickly share with you that price can only ever do one of four things. Price can go inside, it can go up, it can go down, like here, it goes down, or it can go outside. So there's only one of four things that price can ever do. And once you realize that, understand that, then price becomes a lot easier to understand. Once again, inside, it can go up, it can go down, and then it can take out both sides of the range. That's the only four things that price can ever do. So going back to one of the first reversal types, that is inside bar and down. So here we have the inside bar and then it goes down. Okay, that's the first reversal type. Second one, up then down. So you have a green up bar, then a red down bar. Third, outside bar and down, outside bar and down. So those are your three simplified reversal types. Now you can definitely get a lot more nuanced and more complicated by introducing more bars in your analysis. So that means, instead of using simply a 2-bar reversal pattern, I may want to look at the previous bar before that bar, or even subsequent bars or previous bars to get more context. But for our conversation today, a 2-bar pattern is going to be sufficient. Maybe even a 3-bar pattern if it's noteworthy. I will draw your attention to it. But the 2-bar pattern will give you enough to spot the reversals. Okay. So you will see in a second that simply using price alone isn't enough, because obviously there are a lot of bars and these play out quite often. The key is to layer in multiple time frames so you're not examining just one single time scale. So that's what we're going to talk about in some of the key takeaways and findings. So let's get to them now, and I'm going to give you a bit of foreshadowing around some of the results here before we actually get into the charts, because I think it's quite interesting, and I think it pays to actually know what to look out for before we get to the charts. So first and foremost, the major market reversals tended to be a function of the run-up. So simply stating was that the bigger the reversal, usually it was a function of how big the run-up was. So in 1929, we had a multi-year run-up that then led to a spectacular, crash that took the stock market down close to 80+%. So you had a multi-year run-up that there were gains were above 200+%, then that pulled back to give a lot of that back, and most of it back for that matter. So major reversals come after big run-ups. So that's a key takeaway. If you didn't know that already, it's logical, but it's not. It just pays to keep that in mind. Secondly, a series of undramatic events typically established a setting for a wide price decline. So if you actually look at the actual tops, so the days where the actual tops happened, meaning it was the high point for that market cycle, if you actually look at the news events for those days, and I encourage people, if this is an interesting topic to you, pick your favorite market reversal or your favorite time period and do a bit of research. That's what I did. I opened up the browser and I punched in my favorite dates, my favorite market reversals, the ones I was researching, and I looked at the daily headlines. Open up the New York Times, open up the Wall Street Journal if you have access. And you'll see that if you look at the headlines, there is nothing particularly dramatic about the headlines of these days. You'll find that to be true for most market pullbacks, even run-ups. In hindsight, if you actually look at the headlines, there isn't any particularly remarkable about these days. These are just normal days that unfolded where people went about their business as usual, but the market just acted in some spectacular ways, or just sometimes undramatic ways. Sometimes the tops that actually happened were fairly non-dramatic. There was just a regular day that ended red, but it wasn't even a big price decline. We'll get to that in a few moments. Thirdly, a major catalyst sometimes happened before the final top appeared. Sometimes there wasn't any catalyst you could agree upon that caused the ultimate top, but sometimes you did. So there wasn't any pattern there. For instance, a lot of this has to do with people actually agreeing to what may have caused the ultimate reversal at the end of the day. But in the 2008-2009 crash, in 2007, the quants, so a number of quant funds from AQR to Renaissance and some of the really big funds, had major losses in 2007, well before the actual market collapse. So this happened well before the actual final top appeared, even well before the actual crash happened. So that's the interesting part, is that sometimes a catalyst occurred that you could say was major, but again, sometimes you need the hindsight of history to tell you whether or not it was a major catalyst. Well, as I said before, interpreting events and assigning blame is unreliable, because even with the adequate passage of time and opportunity, it's still very, very difficult to assign cause. We all like to assign cause and determine causation, but even after analyzing some of these events like that took place, like look at 1929, that's 90 years ago, there's still people debating the actual cause of that particular crash, and there is no consensus. There's some things that people would say, yeah, that is a possible. Those are possible causes, though those are shared causes. But right now, there isn't any true consensus around many of these crashes. Years after the fact. The last takeaway on this particular slide is that a higher high was often created to lure in late traders. So, in many of these examples, you don't get a chance to offload your stocks at the top. In fact, the markets broke down after the highs were created. And you have higher highs created to lure in late traders, or to stop out people who are short before the actual selling occurs. So, this is kind of a twofold nature of markets, where number one, it's trying to lure in late traders. The guys are chasing momentum, chasing gains, and they're worried about missing out on the trade, and they're getting caught up in the hysteria of the late market cycle, and they get lured in just to get stopped out or face losses right afterwards. And at the same time, you may have folks who are on the short side who are very well aware that this is a market that is perhaps going to break down, but they're getting squeezed. So they got short too early, and that means they're wrong as well. Their timing's off, and now that late market run is squeezing them, and it's part and parcel of that late market run up. Shorts are getting squeezed, and new monies or late monies coming into the picture. Okay. This last point talks about the reflexive nature, as George Soros puts it, of the markets, and the feedback loop that was often inspired by some of this major selling. So from the studies that I've done, every single all these major market reversals, when things look calamitous, it inspired government action. So, I've talked to a number of traders and some folks that I coach, and this past week, and there's a number of traders who are out there saying, I wish that Trump wasn't tweeting. I wish the governments didn't get involved in our stock markets. I wish the Fed would leave the markets alone. As if the markets was some sort of place where there was no government intervention. But that marketplace does not exist. This idea of the invisible hand regulating all things doesn't exist. That's not the world that we live in. In fact, throughout history, if you look at the history of the markets, the government has consistently, government and politicians and other financial institutions have consistently stepped in to try to support markets. And it's in their best interest to do so. Obviously, government wants to protect their economies. And these financial institutions, they also want to protect their lifeblood. A bank does not want to go out of business, as an example. So what have governments done? And you'll see this across time. They've lowered lending rates. They've lowered interest rates. They've actually bailed out companies, from the likes of banks to insurers to actual hedge funds, and so on and so forth. And so for a time, you'll see that some of this government intervention has worked, but then the fundamentals become so poor and so obviously bad that they stop working. So this is oftentimes the cause for this late higher high. Governments come in to try to prop up the marketplace so that it doesn't collapse. Traders, the markets interpret that as being positive. They push it up higher, but then eventually they can't support it any further, and people, catch the reality for what it really is, and the selling begets more selling. Okay. And the final thing I've talked about already is the top appears oftentimes well before a crash, and we're going to get to that when we actually look at the charts. Okay, next slide. Here are some things more around price action. Okay, so the actual crashes, so when I talk about a crash, this is when you have the actual steep selling, the big red days where price is going down 3, 5, 10% at a time. These crashes always occurred on full time frame alignment. When I say time frame alignment, it means across timescales, they were all red. So the timescales I'm referring to for my analysis were the quarterly open, that's the 3-month chart, the monthly open, the weekly open. So those are the major, these are the higher time frames, then the daily open. So crashes occurred when these larger time frames, these larger time scales, when they traded red. Okay, so when you're trading and you look at it, you're looking at a 3-month chart and it's red. You're looking at a monthly chart and it's red. You're looking at a weekly chart and it's red. Under those conditions, that's when you had these bigger market sell-offs. That's when they occurred. Because by definition, in order for it to be a big sell-off, you need to turn these bigger time frames red, right? It's hard to have a 80% pullback by definition if you have a green 3-month chart, right? It's very hard to turn that thing red. It's really hard to consider that a big sell-off if the bar is still green, because whoever's looking at that chart is still thinking it's a good-looking chart. So you'll see this when we get to the charts in a few moments, is that the time scales matter. So specifically, it's important, this is why it's so important, to see price across multiple time frames, to not be so short-sighted to look at just one time frame and try to make assertions from that time frame. Because there are so many bars put in on every single chart, you need to use the advantage of time scales to be able to see these same patterns across time scales. Because the time scales represent different investor/trader types. So for instance, if you're an investor and you're making decisions on the 3-month chart, or let's say the yearly chart, then you have a very, very wide time horizon. Monthly chart, still a very wide time horizon. Different investor, perhaps a different investor, different investor type. Weekly, you're getting a lower time frame, but you're still going to be in a trade that's if you're making weekly decisions, you're still going to probably be in a trade that's going to be months long at a time. A daily trader is more like your typical swing trader who's going to hold that that instrument, that position maybe days or weeks or maybe a few months at a time, but not like a person who's looking at a 3-month chart who's going to be looking at that chart and perhaps holding for years. Folks who are looking at intraday charts, obviously they're intraday traders. As most intraday traders, they'd rather be done by the end of the day. They don't want to put on a trade on the intraday time frame and try to hold that thing for years. So by using these multiple time frames or time scales, that's when you get to see the different investor and trader types. And you'll see the structure, which is most important. So by definition, in order to have these bigger sell-offs, then you need to be able to turn some of these wider timescale charts red, right? Because you can't have a big sell-off if some of the time frames are still green. So I give the example of the 3-month chart still being green, but again, you see it all the time with stock markets on a weekly basis. The news will say, it's a terrible day today. One day, but the actual week is still green. So in the context of things, that green day, that red day was probably a buying opportunity because the week itself is still green. So that's why you'll see that it's important to look at, not just the one time frame, but look at multiple and look at the structures in each time frame. Next takeaway: don't look for confirmation in the news or analysis. So as things are selling off, if you're trading if you believe you're trading in a market that has the potential for correction or a strong pullback or reversal, don't look for that to appear in the news or on the headlines, because the reality is that you can't believe the talking heads. After doing the analysis and you look back at all the major reversals, you pull up some of the headlines and you pull up some of the interviews, and I'll share some with you during the the charts section, is that you had folks who were talking up stocks and talking up the markets as things were selling off. You recall if you were around for the .com days, you had many analysts who thought these companies were still healthy and they had good valuation and good prospects. And many of these companies went to zero, as you well know. Same thing with the economy itself. Many of these analysts cannot agree on anything. At the end of the day, as traders, our job isn't to try to understand why things are happening. It's comfortable, right? That's the part that is so alluring, that it's comfortable to try to figure out reasons. But as traders, that's not what we get paid for. We get paid to speculate, and you don't get to speculate when you have all of the news. If you have all the news, it's no longer called speculation anymore. Then that would just be called certainty. So speculation is the name of the game, and that means we have to operate in this environment of ambiguity most of the time. Okay, and as I said already, there's a structural component to a correction. I talked about this point already. Not all price patterns create the same results. So just because you have an inside bar and then a down bar, it doesn't necessarily it's not going to lead to a crash, because the structure behind it on different time scales will look different. And so that means a simple correction on the daily time scale, if it doesn't have structural weakness, then it's probably just a healthy pullback. However, if some of the wider time scales have structural weakness, and I'll talk about what that means in a few moments, we look at the charts, then there's the potential for these bigger pullbacks, these bigger sell-offs. Okay, so we'll save this last bullet point for the actual charts now. Okay, so there once again are the 5 studies. Let's get into them now and get to some of the charts. So just some quick stats. We'll just quickly review things so that you can kind of see the lay of the land. So the Wall Street crash of 1929 again went up 150+%. I gave you some stats around the date of that cycle high, the day of the week that happened, the high, the cycle low, the day of the week that low got hit, and then the peak to trough losses and the length of some of these pullbacks. Okay, so again, the one that was quite interesting was the 87 crash. That only lasted 56 days. So not dissimilar to what we had in 2018. So 2018 here. So this is the amount of time it took for this thing to play out, but it rebounded very, very quickly. Okay, so you can see here, cycle high was 20. That hit we just recently peaked out last September on the 21st. Then the low was put in on the 26th of December. So a 3-month pullback there. Okay. Even though the majority of the selling happened in the month of December. We'll show you that in a few moments. All right, so let's take a look at the first major market reversal, and that's the crash of 1929. So as I talked about already in the previous slide, we had 150+% run up. So back in 1927 here, they had a 12% pullback, but then once it popped out of that from that pivot low, right to there, it went up 156%. So quite the run up from 1927, the June time frame, to June of 1929, around that area. So basically a 2-year run that gave it 156% gains. Then they had that steep crash that occurred. So the steep crash happened, and in the span of, this is the monthly chart, of 1-2 months, the Dow had dropped 50%. So you had a 50% pullback here. Then what was surprising to a lot of participants, and even if you do the analysis, from the bottom of this pivot here to that pivot high is actually a 50% run up. So many participants thought they were out of the woods, that the bear market was over when it went from here to there, right? Because it retraced 50%. Now, I'm not a big believer in Fibonacci lines, but there are, after doing the analysis, there are some interesting levels. The 50% one is quite an interesting level. The 61.8 is quite an interesting retracement as well, and we have seen that play out across a few other markets. So clearly, the prices, and the people are looking at these levels, and here, it came close to 50%, a little over it, touched it, and then pulled back down again, and then overall, from peak to trough, it had a 90% pullback. So, if anyone who got long here back in 1927 and had a 150% gain, they gave it all back and more, because markets did not bottom until mid 1932, and that's when the war started to the idea of World War I started to get pushed out there, and that's what took America out of that Great Depression. So some of the macro factors before we actually get to the charts: the Wall Street crash of 1929, also known as the stock market crash of 1929. Was at that time the most devastating stock market crash in modern financial history. Of course, there were some big ones prior, but not in the U.S. There's the tulip mania crisis in Europe. Then you had the South Seas bubble. So you had a number of different bubbles that have occurred in the past, but this is the first one that happened in modern financial history in the U.S. The notable dates we'll talk about: October 24th, Black Thursday; October 29th, Black Tuesday. While no consensus exists on the precise causes, many agree that one of the primary causes was that government attempted to actually slow down the market gains, along with media, to kind of slow down the speculation. And you see this across time in history. Governments are in a very precarious position when it comes to dealing with market bubbles. As much as people like to throw Greenspan under the bus for letting, a couple of bubbles happen under his watch, the question is, what was he supposed to do about it? So if history is any leader, or it will help us inform us at all, we've seen in the past that the best or the most that governments can probably do is that they can try to talk people away from speculation. Because once you start getting into the game of increasing interest rates to try to slow down speculation, then that's very, very risky, because now you're affecting larger parts of the economy. So in the past, what governments tried to do was they simply tried to talk down people from excessive speculation. Has it been very effective? Not really. But unfortunately, you don't have a lot of remedies for when people start to develop manias. So this whole mania of crowds and crowding and herding that tends to play out during bubbles is very dangerous, and the regulators and the governments know this, but they have very few tools which they can use to actually effectively curtail these bubbles that get out of control. So the second attribution for the 1929 crash was the great expansion of investment trusts. So think of these investment trusts as equivalent to your modern day hedge funds or large ETF funds, where investors, if you wanted to gain exposure to a broad number of stocks, and you didn't or could not purchase these stocks individually, then you could expand or you could buy into these investment trusts who would be holding companies to hold these stocks. So you get the exposure of the markets or of these companies by buying into these trusts. So history has also shown through the analysis that many of the market crashes came as a consequence of these new financial innovations that came to Wall Street, which is why folks like George Soros and Warren Buffett, the Warren Buffetts of the world, just hates some of these derivatives and some of these financial innovations so much because there's so many unknowns about them. So back in 1929, these investment trusts were not very well regulated, and these are your modern day, these are your old school hedge funds. At that time, they did not have a lot of regulation around them, and so they grew very, very quickly, and unfortunately, they grew without a lot of regulation. So there's a lot of margin buying by all parties, and this helped fuel the run up at the end in the utility stocks. So the utility stocks at the end were the ones that were really driving the markets higher. There was a real high concentration in public utility stocks. Okay. So as I said, they were all highly levered, using large amounts of debt and preferred stock. These all seem to be factors that eventually led to that triggering event. Okay, so let's switch gears now and let's actually look at the charts. So we're going to jump over here to our charts, and let's begin here by explaining what we're looking at. So I'm just going to make sure you can see all that. So first and foremost, let's define what we're looking at here. If you don't know, if you can't see my charts, I'll just quickly explain. I'm just going to fix a few things here because I'm seeing that we don't have the right time frames. Okay. So on the bottom right hand corner, we have the monthly chart. On the bottom left hand corner, we have the weekly chart. On the top right, we have our daily chart. On the top left, we have a 2-day chart. So here again is the importance of examining price using multiple time scales. You may see some blue line. You may see some different colored lines. I'll explain what those are. So I'll just zoom into one of them here now, so you can see what they are. So the blue lines here, you'll see this big blue line. That is the quarterly open. So that's where price opened on the quarterly or 3-month chart. Okay. The orange line, that is the monthly open. So where price opened at the monthly chart, and the blue line is where price opened on the weekly chart. So part of my analysis was to get an understanding of how price traded in relation to time itself, okay, across the different time scales. Now, interestingly enough, I'm using TradingView as my charting platform for this analysis work. And unfortunately, TradingView, they didn't have a lot of historical data going back to 1929. So I had to choose this one particular contract, DJI, which is actually a CFD. It was the best one that they had that had the data. But unfortunately, even then, for whatever reason, on the daily chart here, they don't show candlesticks. I don't know what the reason is. If someone knows why that is, you certainly let me know. But the 2-day chart is fine. So the 2-day chart, you can see there we have regular candlesticks. So if you're uncomfortable with with your line charts, then look at this chart over here. We'll do both of them. At the end of the day, price action, again, we're not going to be looking for patterns necessarily. I'm looking and examining the individual bars themselves in relation to the wider time frames and to the opens of those time frames. Okay, so let's get to the charts now. Well, enough of the setup work. Let's get into the actual charts and let's see what's of interest. So let's zoom in now to the daily scale. So on the daily chart, okay, actually one quick thing before I jump away from the daily. The 2-day chart. Well, why do I use the 2-day chart? Well, the 2-day chart does a really good job of aggregating the daily chart and kind of smoothing out some of the edges that you get from the daily chart. So if you want a little bit less sensitivity, that's when I'm using the 2-day chart to aggregate the 2 days worth of data into one bar. If you ever used Heikin-Ashi, that's what Heikin-Ashi does. It's basically a 2-day bar, but they also do some averaging. In this case here, I don't like the averaging because I don't want to lose the edges I don't want to average the data. So I'm using a 2-day chart to, get the 2 days worth of data in one bar, but I'm not losing the edges by aggregating. Okay, that's enough for the definitions. So here is your Dow chart. It peaks here. Okay, August the 30th, 1929. There's your peak, and you can see that a number of days, a number of weeks, in fact, actually a number of months actually transpire before we get our big market sell-off. So here are these red bars here that talk about the big market sell-offs. Here in red is the first big data point for 1929, and that was Black Thursday, the infamous Black Thursday. If you look, the stock market was only down 2% that day, but if you actually look at the actual bar itself, you'll see that this was a massive range bar. Look at the size of this bar from the high to the low. Okay, so even though it was only down 2%, the day prior it was down 6%. So going into Thursday, traders were already very, very nervous as things were breaking down. Okay, so it's breaking down, it flushes. So this day's range is actually bigger than the previous day's range. So from top to bottom, you actually had a bigger sell-off than Wednesday. However, on Black Thursday, because of the fright going on and just the general calamity in markets, bankers actually came together to actually begin to buy stock to try to show confidence in the stock market. So Whitney, who was one of the Fed chiefs at the time, with the money from various banks, went onto the floor like Morgan had done back in the day, and bought up U.S. Steel that was trading. He bought it well above the actual bid-ask price to show the confidence in the system. So this sort of worked. It curtailed the selling for that day, and even the president himself, Herbert Hoover, reassured Americans that the economy and business was sound. So here once again you have institutions, you have the government, you have folks intervening in the markets to prevent more calamitous price action. So that stems the selling. Stems the selling for that one session. The next day you have an inside day. So there's our inside bar. We'll get to the price action in a few moments. I'll just describe the history first. You get your inside bar. However, the inside bar breaks, meaning you had 1 day of respite, right? Respite. So there's Wednesday, Thursday, Friday. Friday you have an inside bar, meaning the bulls can't take it higher and the bears can't take it lower. Going over the long weekend, right? Going into the weekend, people are nervous. What happens on Monday? Boom, here. Okay, gaps down and ends up being a really bad Monday. There's your Black Monday. And it sells off 13.47%. So really, really big selling on Monday. Followed up by Tuesday by another 12% selling. So 12% red day. Okay, and you can see that here, again, America's elite try to step in to demonstrate their faith in the system. The Rockefeller family, the Durant family, they come in, they buy a bunch of GM to try to show that these folks are, that they still have faith in the system. But they can't really stem the tide. They do get a bit of a two-day bounce, right? So here the market bounces 12%. So really, really big bounce off that. Recoups the losses from Tuesday. On Wednesday here, you have a brand new month. So there's your new month, and the selling starts again. And here things fall back down, a close to 6% drawdown, 10% day down, plus 3, another 2 big days down, creating a new lower low. So this here's low is lower than that low and creates the lower low. So if we zoom out now, let's just zoom out. We can see that this selling went on for a long time. So we saw the picture already earlier. So we had basically 3 months of red bars. Then it pops up, right? So we had 1, 2, 3, 4, nearly 5 green months before the selling began again after this 50% pullback. So this once again is a 50% pullback. So drawing from the pivot high, pivot low, Here is your 50% area. That's kind of your Fibonacci area. And then markets just they just sell off until you get down to close to 80+% of losses. Okay, so let's just examine the price action now, and what can we see that's notable with the price action. We'll look at the 2-day chart. We'll look at the 2-day chart, the daily, the 2-day, and the weekly. So a little bit of explanation. So here we have an outside bar. So we know what an outside bar is, right? An outside bar is when both sides of the range get taken out. And typically, what outside bars indicate or tell you is that traders, both buyers and sellers, are getting more aggressive. By definition, they're getting aggressive because they're taking out both sides of the bar. That means both parties are getting involved to the extent that they can actually take out both sides of the bar. And usually what this means is that there are people who are incurring losses at either ends of those bars as people put their stops or getting chopped up inside that bar. So anytime price then breaks above either the high or the low, it shows you that there's a lot of aggression. So it's usually a momentum trade, as the folks who are able to break this impasse now have control of the price action. So in this case here, you have an outside bar that goes up. You have another outside bar that goes inside. It's also a significant pattern. So by definition, you have an outside bar where people are getting aggressive, but all of a sudden you have a consolidation bar, an inside bar, meaning the range is contracted. So think of the outside bar as expansion, meaning there's a force at work. People are getting aggressive. Then the inside bar is your contraction. That means neither side now has the advantage, and they're unable to break the prior bar's range. So whoever wins this fight, this little incursion here, whoever can break either side of this bar is now in control of the price action. So in this example here, back on the 21st of August, you go outside bar and inside bar. Now you break the high of this bar, the buyers are in control. So they are able to push price now to all-time highs. You get the all-time highs. So there's your all-time highs. There's your up and your down reversal. That's all it is. Up and down reversal. That was the type of day it was. Nothing particularly, on this day here, the 3rd of September, nothing particularly amazing about that day. Look at it. It's a 0.22% day of a gainer. Do not have volume, and you'll see in the slide where I talk about additional areas of research. There is not volume for this particular contract, so unfortunately there's no volume to take a look and see what the volume was. But I'm sensing by the size of these bars that volume is probably not very high. So this is not what you consider any kind of blow off top. Just a regular bar. Up, down is your correction. Okay. Then you go here, outside bar and inside bar once again. Outside, inside, exactly the same as what happened here. However, this time they break it to the upside, but it fails. So this is your inside bar reversal. This is an idea of where anyone who bought this to the upside, if it fails, they're going to get stopped out when it breaks below here and there and there. So it fails. So this is a failed pattern to the upside, and it breaks down now, and that ends up being the trigger for a lot more. This becomes one of the last outside inside conditions before things break down. Here it goes inside outside. So inside consolidation, and then all of a sudden you have aggression by the sellers, pushing it down, taking out the prior bar's range, and then that kind of marks the high point for this particular market cycle. So that's interesting price action itself. Once you get down here, you start seeing these inside bars, and these inside bars are basically just consolidation points for more selling. So what's notable is, look at some of the lines. Okay, so the purple, as I mentioned, is your weekly, orange is your monthly, blue is your quarterly. You don't get the really, really big selling events until, as I said in the slides earlier, until you have full time frame alignment to the downside. When price breaks below all the major time frames, that's when bad things can happen. See these 10% down days? They don't happen when price is above the quarterly open. They happen in this condition when it's trading below the week, below the open, below the month. Below the week, below the month, below the quarter. So in this case here, look, the selling, the top happened right there. Okay, that's the first day of the month, first trading day of the month, September the 3rd. Once it broke below the monthly open and the weekly open, it can no longer reclaim that high. So that's something you need to watch out for, meaning anyone who's looking at the monthly chart here, for the entire month of September, it's a red chart. If you're only looking at the monthly chart, or you're only looking at that particular price point, you're looking at how it trades in relation to the monthly open. Where did it open up last month? If you're looking simply at that, you know it's a red month. Okay? If you're looking at the weeks, look, it's trading below each week's open for the most part. So the trend is primarily down because you're below the weekly open, you're below the monthly open. The only thing that's telling you that's not falling apart yet is that it's trading above the quarterly open. So if you're looking at how things traded last quarter, then things are still, trading above where they opened last quarter. But once Q3 hits, Q4, it breaks down. Okay, it recovers briefly back above, but breaks back down again here. And this is your this is the where bad things can happen, and you get that break in that selling. So that's the type of analysis we're going to be looking at. It's the price patterns, so the actual price bars themselves, what types they are, their sequence, and we'll look at things in relation to their time frames and opening prices. Look at the 2-day chart. So 2-day does something like this. Okay, so there's our price. It goes inside bar and up, then it peaks out right there. So anyone who bought this bar, they get, these are 2-day bars, so a good 4-day run. Then it creates the higher high. Okay, so you're getting right in the highs, and then it falls apart. Okay, so that's why the markets are always luring in traders late, because it's always creating new highs to bring in new inventory, to bring in new liquidity. Smart money's oftentimes getting out tops as well because they know they're going to get filled up there. There it goes 2 up, 2 down. So there's your 2 up, there's your up and down reversal. It goes then inside bar. So inside bar and down. Okay. So there's your reversal, and then we talked about the rest already. Now what's it look like on the weekly chart? So on the weekly, right there, outside bar marks the high. Okay, so outside bar marks the high right there on the market cycle. So outside bar, as soon as it breaks below this outside bar, the sellers are in control. And in fact, they don't let up for 1, 2, 3, 4 weeks before the buyers can break up above that bar's high. Look, this is the fresh quarter. So see, it rolls down for the rest of the quarter. The new quarter hits, they take out this high. This is the new quarter. First week of the new quarter. It's a green week. But as soon as they break the weekly's low, you break back down into full time frame alignment to the downside. So here, back below October 7th low, you're trading below all the major time frames now, and that's when you get that collapse. That's when bad things happen. Here's something quite notable as well, right here. Outside. So 2 outside bars in a row. That's not necessarily significant, but what it tells you is the following, right? So you have a green outside bar right there. You have a red bar here. So you have 2 bars now where people are getting aggressive. But now look at this bar here. So the buyers get more aggressive and they take out the highs of this red bar. But not only that, but look at price opens. So price closes the week prior down here, but it opens here. So we have a gap. Okay, so we have a gap that happens over the weekend. That means traders who are short here, thinking maybe you're going to break down, they got trapped. And so I just showed you the momentum and strength of the bulls as they were able to push it up this week for another 7% gain, plus another 3%, 4% gain, plus another 1.5% gain. So they had to, they were able to do another, 12, 13% worth of gains before it finally, pulled back down. So anyone who tried to get short here, they got run over as they gapped over them and kept on going. Okay, so really interesting sequence there when you break it down to the different time scales, and you see, just the actual behavior based upon the price bars. Okay, so that is our analysis now on on Dow on the 1929 crash. So again, some of the key takeaways to understand as we go through some more of these is we want to be seeing how price not only reacts to obviously the opening prices of the different time frames, but in order for there to be any major reversals, by definition, you have to start taking out lows, right? So as I mentioned, in the preface, look at the weekly chart once again. You cannot have a major reversal until you begin to take out weekly lows. So there, right? Here, you take out that week's low, and then it continues to break down and create new lows. Up until then, right, you weren't making, you were breaking below, but it would quickly come back up again. So this example here, you have an outside bar and it goes down, and if you're a seller, you want to see it keep going down, because if it stops going down, then it can pull like here, it can pull back up again. So price, the best you can do sometimes is simply follow price. But with the intervention of timescales, it'll help you keep you on the right side of the larger trends. So let's go on to our next case study. Next one is Black Monday, 1987. So it's funny how all these days where you had heavy selling and these sell-offs, they were all black such and such. But we have another Black Monday that happened in 1987. So the 80s were really marked with some kind of wild swings because of the prices of anyone who was born or lived through the 80s. The economy was not great at times. They had some really big issues around oil prices, commodities. Interest rates were very, very high at the time, and so you had some pretty wild rides. So here, from 1981 to mid 82, the market corrected 28%. Okay, here in 84 to 85. Down 14-15%. Then it had a terrific run. So things finally came together at that pivot low here, mid 84, and it ran up until mid 87. And from there, you had close to 130% return in that time frame. Then things kind of fell apart briefly for a good 2-3 months here. We had a really, really big pullback. So there, those 2-3 months, we had a 36% pullback, and that was your major sell-off on Black Monday. That's what kicked it off. Well, not kicked it off, but that's what really amplified the correction. So here's the macro picture. So Black Monday refers to that particular day on Monday, on October 19th in 87, when markets around the world started crashing. It began in the East, so it began in Hong Kong, and spread to Europe, and then hit the United States after other markets already sustained significant damages and declines. And this is really the first market in history where they actually had the use of futures. So here now they had derivatives. This is the new financial innovation for that particular market cycle. Was futures and options, and of course portfolio insurance. We'll talk more about that in a few moments. So once again, no definitive cause. You can't say it was the futures, it was the portfolio insurance. But a lot of people are pointing to those things as as factors. That's the best we can say about that. They were factors. The mid 1980s bull market was fueled by so that run up was fueled by the 1985 Plaza Accord, which was basically lowering the value of the dollars. So it dramatically increased the global liquidity. So once again, liquidity found its way into the markets. The Fed easing cycle began to change, and it caused the collapse in the price of oil and the emergence of leveraged buyouts. So this is the time of Michael Milken and the leveraged buyouts. 1987, all three of these factors were then called into question by the Fed as they began to tighten. So here's where your monetary policy begins to potentially affect things, as the Fed is also worried that maybe things are getting a little bit too speculative. So you have an additional currency crisis, or additional currency dispute with Germany and the U.S. Okay, and Congress starts talking about proposing some taxes and reducing the actual tax deductibility of those folks using leveraged buyouts, so the LBOs. Okay, and then once the selling begat selling, then the portfolio insurance and all the talk of regulation exacerbated the declines. So here once again is the run up, Oh, excuse me. That's the next chart. So let's just look at the actual price now of 87. Okay, so here's our 1987 chart for the. I'm using the SPX contract, and there's our market high. So there's our cycle high right there. Let's look at the daily chart quickly. And so there's our cycle high. The date is August 25th, 1987 is your cycle high. We follow that with an inside bar, so the reversal condition ends up being inside bar and down. Okay, so that's the reversal condition there. Scroll over, and here are our big selling days. So there's when selling began. This is a 3% down day, and this is when the news organizations began to report that Congress or the House of Representatives was talking about eliminating some of the tax benefits with some of these LBOs. So at the same time, the Commerce Department announced the trade deficit was way above expectations. So the Fed here was talking about potentially start tightening. So interest rates begin to rise, and it puts additional pressure on equities. No one likes to hear rising interest rates, especially now when you have price starting to sell off. You're adding fuel to the fire, and this is the challenge of any regulator: is how do you responsibly manage the stock market and not cause this type of catastrophic sort of feedback loop. This is why regulators are so gun shy now to do these types of things. Here, there's your Black Monday. So right there, October the 19th, you have your 20% pullback, sell-off, which is really one of the first times, in recent memory, you had that big of a sell-off. People, you don't forget, this is a very calamitous event. We had, stories of people jumping out of brokers jumping out of buildings because of the losses sustained on that one particular day. But look at the lead up. Okay, so that's Monday. Okay, so here is the week prior. There's your Friday. Friday was already a 5% day down. Thursday, close to 2.5%. Wednesday, 3%. So Mondays are, this is when things can go awry, can go wrong, because people over the weekend, if things don't improve, they're stewing on their losses. You have 3 red days in a row. You go into the weekend, right? And it just sells off the whole session. Finally, on this day, which is the Tuesday, before the financial markets open, the Fed gets out there and releases a statement. It says that they want to affirm that they're there to support the economy as a source of liquidity and to support the financial system. So you can see, as already it's pointed out, is that the Fed will actively get involved in the open markets. So here they push down the Fed funds rate down to 7%, and over time, or over other short-term interest rates also get lower. So this increases the liquidity. So many people like to say that this was a far different, it was a way better response by the Fed than what we had in 1929. As here, people had confidence in the system. There was more money sloshing in the system, and allowed people to get out of some of their trading positions. So there you go. That was kind of your bottom. So that day there, on the 20th of October, was the bottom of that sell-off. Okay. So let's go look at the price action. So back to our market high on the 2-day chart. Inside bar and up, then it goes up and down. Okay, so nothing too remarkable other than to say that this was if you took this trade long, it got to a new high. So you bought the high at this bar because you believe that the consolidation breaks to the upside. You buy that, you're buying right in the highs. What happens when you buy in the highs? If there's no more new buyers, it pulls back. So that pulls back on the weekly chart, pulls back, and it ends up being a up and down reversal, right? Up and down. Even though it's a red week, you still had a higher high than that high, and it goes down and takes out that prior week's low. So that's what you want to be watching for. You want to be watching for these prior lows getting taken out. Look at the the monthly chart. The prior month's low gets taken out. That's when things can begin to reverse. These bigger time frames reverse. That's when you can get these bigger reversals. Okay. Now, if you quickly take a look at the actual time frames now, so here, so there's your top. Happens on the 25th. The big selling, as you mentioned already, didn't take place until the 14th. So that's a good 2 months. So you had 2 months where you had trading going on. So here, if you take a look, we're drawing our Fibonacci's once again. Again, I'm not a big believer in it, but it's interesting to see. There's your 50. This is close to a 61% retracement here from this high to there. Okay, so they buy it back. Then it falls down. Exactly when? Well, when does the action really break down? It stays below the quarterly open. So there's your quarterly open. A new quarter rolls around right here. Okay, there's October the 1st. You have a few green days, then you have a brand new week. That brand new week starts there. Then on Tuesday, it takes that low. Then you have a red week, a red month, red quarter, and that's when bad things happen. Okay, so that's what you want to be watching out for. Interestingly enough, you have, I'm just going to point this out because it's an interesting reversal pattern to the on the opposite side, on the buy side. So you'll see that the actual markets bottomed here. On the low here was put on October the 1st, but where the markets actually begin to come back up again is here. Right? So look at the reversal here. Inside bar, it goes down. But they can't keep it down. Once it breaks above this high, it's an inside bar reversal, meaning anyone who shorted there, they're going to have to cover at some point. So here, once they cover, it goes up. Right? So it breaks this bar's high, and then it's off to the races. Layer in the fact that this is the quarterly open. So this is a monthly chart. Once it breaks above the high of this particular quarter, now you have things trading back above the quarterly open again. So over here in January of 1988, you're trading back above the prior quarter's open, the quarter was open, and you're trading back above. You got a green month and a green week. Okay, and just one more thing there. Same sort of pattern here on the weekly. Oh, excuse me, I want to go back to my monthly here. Okay, let's go back. On the weekly, we have this scenario right there. Same thing. It bottoms quicker on the weekly chart. So the exact same pattern. Inside bar and down, right? And it breaks here. So anyone who got short here, they made really good money down here because it went down close to 7%. But then once the high got taken out, then these guys get stopped out at the brand new month. So this orange line, your brand new month, there, you got a brand new month. Things are green, gets into that new quarter like we saw over here on the monthly chart, and then things continue to go upwards. Okay, so interesting lessons there from 1987. Let's now talk about 2000. So there's your dot-com bubble. So the run-up was quite spectacular. So from late 1998 to early 2000 or mid 2000, we had close to a 280% run-up in NASDAQ stocks. And I'll be using the IXIC contract to do the analysis. Then we had a very spectacular pullback. So basically, if you go back to that step here, so don't forget we started here in mid 98 was the low, comes all the way down and stops them out. So if you had bought here 98, thinking, man, I'm up an amazing amount of money because you bought here and you held somehow all the way to the top. Well, it tested the entire move and even further down, so it pulled back 78%. Okay, so it took out that prior low before it bottomed out and started to come back higher again. So a very, very drastic pullback. The macro dot-com bubble, also known as the tech bubble. was quite the historical precedent in the United States, mostly around the speculation of IPOs. So that was the big IPOs were not the financial innovation. The financial innovation that got pushed forward was, we had these tech companies that were internet based. That was the big innovation, but it was taking these tech companies IPO. That was the big innovation in that era. So from 1995 to 2000, extreme growth in the usage and adoption of the internet. We had many different online companies that became popular, pets.com being a big one, Webvan, companies like WorldCom, which most companies are not in business anymore, NorthPoint, Global Crossing, all failed and shut down afterwards. Stocks like Cisco, they did decline close to 90%, and Qualcomm, they lost most of their market cap, but ultimately they did survive. And some companies like eBay and Amazon actually declined, but they actually recovered very quickly. So that's been the lesson of the dot-com days, is that maybe some of that overinvestment in infrastructure actually ended up allowing some of the growth in some of these other companies that we now have as tech leaders. So let's get into the charts now. Let's go to 2000. All right, so here's our NASDAQ chart. And so now that you're getting accustomed to the analysis that I'm doing, I can move along a little quicker and not have to belabor the point as much anymore. So getting to the daily chart. Cycle high right there. Okay, so there's March 10th, 2000. Puts in that higher high before coming down. And actually in this case, actually creates a lower low. So let's look at some of the macro here. So some of the stories. Here, back in January the 7th, this is when AOL announced that they were going to merge with Time Warner. Okay, and this is going to be one of the biggest mergers of all time. There. Alan Greenspan was talking about, was maybe raising short-term interest rates to head off some of the inflationary pressures that were coming off of this booming economy. So he had been talking, he had been trying to talk down the stock market, with his famous words of irrational exuberance. And here he had to start to step in, because by any measure people were talking about this being a bubble. He had to take some sort of action. There we have our high. So this ends up being an up-down reversal on the one-day chart. Then news comes out the day after, the 12th, saying that Japan is once again in a recession, and that starts to create a global sell-off. Pulls back, heavy selling, 4% down day, 2.6% down day, but then markets recover, right? So here we have a pretty big pullback here. So from here to there, then pulls back up. That's, it nearly pulls back the entire pullback here. So it doesn't create a new high, but it's a lower high. But once again, the markets are luring in late buyers here. As if you recall, the analysts are still talking up stocks right into the end. And then if we have any final data points, I'm going to go back here. Yeah, there's one more over there. Okay, one final one over here. And this is when pets.com goes out of business. Okay, so again, the actual market high, once again, was put here, March 09. And for some of these companies start going out of business, here was, November. So we have a good 8-month window. Here are some of the really big declines that happened on this particular market reversal, were these days here, right? So here we had a big day. We had a minus 7.6% down move. This week here was a very tough one. This week here, minus 6, close to minus 6. Here's another minus 3% day, another minus 7% day. So this is basically a complete red week, another 10% day. But look, once again, not to belabor the points, but I think you're getting it now. Just look and see how price transacts around those time frame opens. Okay, once you get below that quarterly open, this is when bad things can happen. So in this case here, right, it pulls back right into the quarterly. You get an inside bar at the end of the quarter. New quarter starts. Once that low gets taken out, boom, look at that day. That's a really nasty day. Ends up being a big hammer. Pulls back a bit, but then it doesn't. We get a new week. Clearly, the fundamental news that was drove this pullback wasn't sufficiently good. People realized the severity of the situation and then kicked back into selling again. So on the one-day chart, you have that up-down sequence, Okay, on the 2-day chart, it looks like this. This is why it's I think it's so important to see these different time frame charts to get a different look at price and to see the structure, outside and up. Okay, so outside and up is the condition. Now once it runs out of steam right there, that means anyone who bought this and went outside and up, so that gaps up. See, that's this. Well, you can't quite see that, but it breaks down once breaks down once these guys get stopped out here. Okay, they try to make a higher high here. Again, outside bar and up. So what we know about outside bar is momentum, right? Once the momentum fails, right there, that means there are no more new buyers. Anyone who bought in this last wave gets stopped out if they're putting their stops there. Got the new week. New week starts off the selling, stops out any late buyers in this rally, and then takes them all out. Then it goes brand new week. We saw this already, right? Outside bar and down. Outside bar and down, down, down. As soon as that bar gets taken out, buyers are back in control temporarily until we get another up down reversal followed by inside bar and down, goes back down again. Okay, so on the weekly, just point that last one out. On the weekly, all we have here is up down. Okay, so up down is the reversal pattern here, but again, you can use more context by looking at this. So this is what starts things off. So here, outside bar and up. So momentum, right? Momentum in a late market, a late cycle market. Momentum and up. And then as soon as this low gets taken out, it means momentum is run out, and it breaks it down. There's a new quarter. There's that big catastrophic week. We had a 25% sell-off. And so once again, this is why we look at the different time frames, right? So we get different looks at things. So in the monthly, up, down, reversal condition, up and down. Really fun. Look at the higher time frame. Look at the 3-month chart. Give it a second to catch up here. Okay. Here on the 3-month chart, up, down, reversal, then it goes inside bar. It goes up, down, they consolidate, then it breaks below the inside bar, and they sell it off. For how many quarters? 1, 2, 3, 4, 5. 5 quarters without any newer highs on the quarterly chart. Finally get a new higher high here. That just lures people in. Then they take out that low, and then once again, selling mode. So inside bar reversal to the downside. Then they get 1, 2, 3 more red quarters. Then look at this, outside bar, inside bar, and up, and then just, that's the bottom of that cycle. Okay, so outside bar and up takes things back up again. All right, back to our slides. So that was 2000. Let's move on to the crash of 2008, 2009, and this probably in my trading history is the most relevant because this is around the time period where I started trading, and I learned a lot of really good lessons. From trading the 2008, 2009 crash. I'd only been trading maybe 2 years at this point when I experienced this market crash. And I think this was was probably one of the most dire market events in recent market memory because of the global nature of this sell-off. It was a global sell-off where it was selling off across all equity classes. You had bonds going down, you had stocks going down, you had these CDOs going down, these mortgage-backed securities, they were all going down, and the financial systems of every single economy were put to the test. So the run up, basically from the end of 2002 or mid 2002 all the way up to 2008, you have 100+% return on the S&P. So it was a good 6-year move. Let's call it a 5-year move that took the S&P to new highs and 100% gain. Then we had that sell-off. So that sell-off that goes from the top of that peak to the trough, let's call it a 58% pullback. Okay. So what's always neat to see about these pullbacks, these sell-offs, is that they create newer lows. And so even if you think you have a good stop, good trade location, and you're a long-term investor, it's going to go below where you think it's going to possibly go to stop out anyone and to test their conviction. So you folks who are in here who've been holding for 6 years, once it breaks below where you bought it, and you've been holding for 66 years, that's going to cause even the most die-hard of investors to really question their beliefs. And that's what the markets do. So, the macro. 2007, it began as a crisis in the subprime mortgage market in the States, but developed into a full-blown banking crisis when Lehman went under in September 15. And due to that interconnected nature of the financial system, the global exposure to subprime loans and CDOs and CDSs and all the likes, the CDS squares, to ensure these loans rapidly devolved into a global crisis. Everyone had this toxic debt on their books. This resulted in a number of bank failures, financial institutions across Europe, and sharp reductions in the value of stocks and commodities worldwide. In the US itself, 15 banks plus failed in 2008. Many more failed years afterwards, and many were actually rescued through government intervention or were merged together with other stronger banks. And in October 11, 2008, the IMF said that this world financial system was teetering on the brink of systemic meltdown. So this is the first time where we had this situation where it was true systemic risk. I don't think anyone in charge at the time really knew what was going to happen. So it was the really first time in modern financial history where the outcome was not known. Yes, things worked out, but you could argue that there's a large degree of luck and just chance that happens that where we are now. There was no clear outcome at the time. If you play that situation back again 100 times, you can definitely get some different outcomes. So let's go to our charts. Back to our charts here again. Okay, so let's review our history, and then we'll get to the price patterns. So this calamity begins way back in 2007. So the high there was put in on October 11th, as pointed out already. But the actual news flow begins well before that. So here, Feb 20th, 2007. This is where some people begin to point that there is beginning to be structural cracks in the financial system. Here, 20th February 07, existing home sales numbers peak this month and begin to decline. So, note once again, you do not know that this is the high of home sales and that they've peaked until well into the future, right? Because you don't know until the next number comes out. But looking back in the past with hindsight and that hindsight bias, you can then claim that this was was significant. But if you were trading this stuff real time, you did not know that was a significant data point. Although the markets did not like that, you can clearly see you had a down 3.5% day there, but shortly after it goes back to new highs again the next month. So in April, more cracks appear in the subprime space. So New Century Financial, one of the largest U.S. prime lender, files for Chapter 11 bankruptcy. Very odd, right? So if you don't believe that subprime is a problem, then why are these guys going bankrupt? Especially the largest player at the time, New Century Financial. They go bankrupt. Fast forward now, so that was April. We're going now to June. So this is again April to June, right? 2 months later, Bear Stearns finally informs investors that two of their CDO hedge funds. So these CDOs are these collateral debt obligations, these derivatives, and again the financial innovations in this time period were these CDOs, these mortgage-backed securities, these derivative products that were very, very opaque. So they had two funds that were very leveraged in these CDOs, and these things were consistently profitable until they were not, and then they went out of business. So basically, it said we were halting redemptions. We're not supporting these funds anymore. That was announced here. Okay, so market did not like that. Once again, did not stop the market from making new highs. So you can see here it's quite tricky price action if you're looking at just the daily chart, because you're getting lower lows, but then you're getting higher highs, right? Then you get lower lows. That low, is that low lower? Low 1370.6, No, that's still lower. So you're still getting higher highs here on this chart. So you're getting higher highs, and then you get the higher high up here. So fast forward. So we were here in June when Bear Stearns talks about some of their hedge funds that are exposed to subprime. They're actually they're no longer available for redemption anymore. That means that they're going out of business. So Cramer, this August the 3rd date, so this happens again. This is now. Look how slow this thing's playing out. So June, now we're in August. So a good 2 months later, Cramer gets on CNBC and he does this famous "they don't know anything" rant about how the Fed was clueless about the simmering subprime crisis. If you have time, it's an entertaining watch. So definitely, Google that particular, Google Cramer and they know nothing rant. At that time, he had a huge 5-10 minutes rant on CNBC where he was basically throwing the Fed under the bus, saying they had no idea about the calamity that was that was going on under their watch. The day after, the AHMIC, files for Chapter 11. Another really, really big subprime lender goes out of business. And then, on this date, which is significant, August the 6th, this is when you had a major liquidity crisis. Some major liquidations begin to occur in the quant space. So a great book called The Quants, and I'll give you the link to it later on in the deck. A number of long short equity hedge funds that are quant based. So the AQRs of the world, the Citadels, the Renaissance, the huge quant funds that were not supposed to be exposed to stuff, start to sustain massive losses. And the financial managers there had no idea why this was happening. According to their models, it was an impossible event, that this should not be happening within their lifetimes. And so they experienced their meltdown way before Main Street did. In fact, Main Street had another 2 months of rallies before things really hit the fan, whereas the quants melted down back in August. And so here, many quants, they were ground zero. They were the canary in the coal mine, because they had that, some of them had that CDO exposure, and the markets just began to trade abnormally based on their models. They were long short many names, but then they were in these pair trades, and they would both be going in opposite directions. So you're in the worst of both worlds. Your longs you think should be that you're hedged against are going down, but your shorts are then going up. So they were getting squeezed on both ends. So quite catastrophic. At the same time, you had a Fed governor come out that same day saying, this is why you can't listen to talking heads, no matter their job title. My own bet, this is from Bill Poole, Fed governor. My own bet is that the financial market upset is not going to change fundamentally what's going on in the real economy. Bank capital is not impaired. So unlike some past cases when losses on real estate impaired bank capital and thus affected the lending in areas that had nothing to do with real estate, I don't think that's the case this time. So here's the Fed governor who is, one of the people in charge of the ship, and he has no clue what's going on at the time, right? They don't understand the severity of the situation. And in hindsight, we can laugh about it, but this is the issue and the complexity of the modern financial system, that even the folks who are tasked to run it don't have all the answers. Okay, so markets go down here. At this point here, that's when the market, in fact, Bill Poole here, that statement was actually sort of ridiculing Cramer, because he thought that Cramer was actually over-exaggerating the consequences of the severity of what was going on. But the markets were not. The markets were saying, yes, there are major issues, and it starts selling off. And this big day here was when the Fed had to begin to step in, because we had some serious, ugly pin action to the downside. So here, the Fed cuts the discount rate by half from 6.25 to 5.75, leaving the Fed funds rate unchanged in an attempt to stabilize the market. So they're They're reducing the discount rate, but leaving the Fed funds rate unchanged. Next, there we have now LIBOR beginning to increase. So this is beginning to show you that banks are no longer trusting each other. They're expecting, they're increasing their interest rates and increasing their LIBOR rates. So that's the interbank lending. Again, this is August now. Fast forward to September. The Fed's, really now seeing the severity of the issue, and they cut the main interest rate now by 0.5 percentage to 4.75. So now they're actually cutting interest rates. It caused the markets to respond. Okay, here, as the markets go up, UBS announces that they're losing $3.4 billion in subprime investments. So as the markets are going up, people are losing money, right? They're announcing they're having losses. Citigroup also unveils they've lost $3.1 billion. And later, a fortnight later, Citigroup writes down another $5.9 billion. Within 6 months, they're down $40 billion on subprime related investments. Then you get your new high. Then you get your high of the cycle. Then things, that's your high. Lures in late buyers. They're looking for, if you're buying a breakout here, you get that breakout to the high on all the bad news. Okay, then here on October the 30th, so about 2 weeks later after the all-time highs, Merrill Lynch's chief executive resigns after close to $8 billion in bad debt. Okay, you fast forward here, there. So this is, again, key. Not key, but interesting. End of October, so this is, October 30th. Then fast forward to March. So a good, 5 months later, this is where Bear Stearns is acquired by JP Morgan. So Bear Stearns, this was quite calamitous. This trading was very, very ugly. People had no idea what was going to happen. Bear Stearns goes out of business and gets swallowed by JP Morgan. Then, fast forward, this is the last data point, from March to November. This is September. So, once again, 7 months transpire, then you get your Lehman moment. This is where Lehman Brothers fails, and they go bankrupt after the Fed declines to guarantee its loans. And that's when the Dow drops 504 points in one single session. This is the same day that Bank of America buys Merrill. And then, once people realized that the Fed was not going to support Lehman, then that's when things really got ugly, and things kind of got, that's when no one knew if the global financial system was going to survive or not. So, that's the story. Let's take a look at the price action. So, interesting price action for sure, because this was a quite, monumental event. So, the high in this case here was actually punctuated by an outside bar. So there's your outside bar high. Goes outside, inside, okay, and outside and down. So there's your reversal, outside bar and down. Okay. So once the selling starts to beget, then more selling begets selling. And then here, you quickly trade below the quarterly open. Right there is the quarterly open. So there's October, comes up, new month, new week, trades below it, and then bad things happen. Boom, boom, comes back up to the close to the quarterly open again, then back down. All the really big news events that look bad are on full time frame alignment to the downside. On the 2-day chart, let's see what that looks like. The 2-day, outside bar on the 2-day. Okay, so you got that outside bar on the 2-day. So outside and down. Okay, so here's the bounce on October. Outside and up, momentum, right? So watch the momentum. It gives you 2 bars. Once that low gets taken out, there. The low gets taken out right there. Now, you're trading full time frame alignment to the downside because you're trading below the monthly open, below the weekly open, below the quarterly open, and boom. There's your stiff pullback from there to there. Okay, so that's the sequence right here we were talking about. Then, same thing here. Outside bar and up, you lose momentum here. You're trading below the quarterly open, and this leaves you open for this type of action. Steep pullbacks. All right, on the monthly chart, what do you have? Outside bar and down, then goes up. Okay, so it gives you all-time highs. Momentum dies here. Inside bar down. So it's basically a two up and down, followed by an inside bar. So you have plenty of time to get in here to short this and play to the downside. Now, interestingly enough, on the 3-month chart, it looks like this. So let's bring up the 3-monther here. 3-month, I'll just move this little thing out of the way there. Outside bar and up. Okay, so your correction is a outside bar up and then down. So there's your up down, but the context is you have the outside bar in the beginning. That starts this, because when momentum fails, as we said already, you just got to watch lows get taken out. Once that low gets taken out, that means you're going after that pivot. So immediately you have 1, 2, 3, 4, 5 consecutive quarters of selling. So that's a lot of selling. 5 quarters of selling. Just again, remember that. And none of these highs were taken out until we hit April of 2009. So there's your, again, this is why it's so important to see the wider time frames. Look at this one here back in 2000. There's a 2000 run up on the S&P. We didn't show this on the Qs earlier, but here, outside and up. There's your momentum play, inside bar. Then it goes up, inside bar reversal, but then it turns into turns into a up and down reversal. Inside bar reversal, I call it, because they try to fake up to the upside. That's a failed breakout. They break that low, inside bar reversal to the downside. It's a very, very nice sequence. Okay, so one final market to examine, and I know we've gone on for a little while now, but I hope you're getting some value out of this. Last market is the most recent one, and that's the 2018 bear market. So back in 2016, we did have a bit of a pullback. So that's I didn't start the actual the new cycle until this thing completed. So here on here from the pivot low. So from the pivot low to the pivot high in 2018, we had a 62% run up. So a very decent run up in that period of time. Then we had a fairly steep pullback. So by all accounts and measures, SPX dropped 20.21%, putting it into bear market territory. So the macros. Now here's the funny thing. It's only been, it's been a little over a quarter since the sell-off happened. But right now, there's still no broad consensus on the reason for that crash. Right? We do know that some possible factors include the threat of rising interest rates. So the Fed had been talking up the possibility of rising interest rates, and they were quite hawkish, and they did raise rates. Slowing global growth, which has been a story that's been going on for a while now. Political instability, both Trump, because of the impeachment, possible, not impeachment, but possible collusion with Russia and all these other reports, and possibly, the corruption charges. And of course, the ongoing tariffs between the U.S. and China. So this has been an ongoing story that has not been resolved yet, and only time will tell which one of these factors was the factor, or if it's multifactorial that caused the steep selling that happened in December. All right, so let's jump to our chart on the SPX. Let's zoom forward now to the most recent data. And so what can we say? So let's start with the monthly here. Let's go to our chart here. So the market's the cycle high right there put in on September the 21st, 2018. Okay, so September 21st. Again, pull up the news. Nothing particularly special about that day. Okay, the markets ended down 0.04%, but that ended up being the high. Okay, pulls back. So here, the high is, the correction is a up-down reversal. That's all it is. Nothing particularly amazing about that. And this is maybe, what I'm hoping you're seeing here now is that to profit from these market tops, to catch these big moves to the downside, you don't have to be first. You don't actually have to catch the top. There's many opportunities to get involved after the top happens. So you don't have to be trying to pick tops all the time. Once you realize that the time frame has broken down and you're trading below the major time frames, then you can start initiating more aggressive shorts. Otherwise here, when you're buying this, or you're selling this, and you're going short on an up down here, you're still above these major time frames. right? And the market's still trying to push higher. So even though it doesn't, if you put your stop up here, even though it doesn't take you out, it's not going anywhere yet. It's basically a flat, a flat week. Look here, this is basically an inside week. Okay, things change significantly here when the new quarter arises. So there's your blue line, there's your orange line. The new quarter arises, and here's the great short signal. This is where I got very bearish, because knowing what I know about time frame alignment, I know this is when bad things happen. And bad things happen when you trap traders. So this is what happened, is that on this day here, inside bar goes to the upside, people buy that. So people buy that, and they're expecting this thing to make new highs and perhaps take out that high. This day here was a Wednesday, so there's your a Thursday, it gaps down. So anyone who got long up here is now trapped. They have no way to get out. This day, for the most part, was a trend day to the downside. So you could not find an easy way to get out without, incurring more losses, because it never came back to your entry. So you had to either take your losses or look for a graceful exit, because if you didn't, you got squeezed, right? So now you're long and the market starts to go against you, and then boom, you have a 3.2% day. So anyone who didn't get out here is really hurting now, because they're like, oh, I should have got out earlier. Now it starts to really sell. So the selling, though, wasn't necessarily straight down in a line like we've seen in the past. Well, not in the past, but in like some occasions, like in 1987. It was very staccato. So remember, this selling happened across 3 months, the whole quarter. So if we look at this chart once again, so there's your monthly, right? Just let's finish this. Up, down, reversal. Here, up, inside, outside, outside bar, down. So inside, outside, and down. We've seen the significance of that pattern already many times. Look at the 3-month chart. Okay, so there. I'll just zoom in for effect. They start the quarter red, and the entire quarter's red. So this is why it's important. You'll see many quarters. Look at the size of these bars. Sometimes they start the quarter and the entire quarter is green, or the entire quarter is red. And that can happen, right? Look at Q1. We had the entire quarter green from the moment it opened to the moment close to the moment it closed. Same thing here, and not exactly the you close near the lows, but you get the idea. These bars are possible, meaning the sellers or the buyers take advantage of the new quarter, and they take control the entire quarter. They don't take their foot off the pedal. Okay, so here on the weekly, we talked about it already, inside week and outside week, and then down. Okay, on the 2-day chart, nothing too spectacular there. It's basically just up, down. Here, watch out. Anytime you see these excuse me, outside bars, you want to watch for them, because here's the situation. Outside bar, up, up, correct? But then once that low gets taken out, right? Once that low gets taken out, that means momentum's left the building, and this is that sequence here. They gap down, trap anyone who's playing momentum, they trap them and they sell them off. So that's what exacerbates the sellings, because people get trapped and they can't get out of their longs. And usually at tops like these, because the ranges are so tight, you can see how small the bars are. People are applying leverage to get bigger gains, because the ranges are get tighter and tighter as you're moving up. And so to get the same amount of gains, you need to apply more leverage. And so now you get paid a little bit of money as things go up, but then all of a sudden it goes against you and you're double sized. So the pain is a lot more, is a lot more amplified, because now you're on more leverage than you were, originally when the markets were, still moving in big bars like down here. But as things get higher and higher up, the bars start to shrink and the volatility contracts. Don't forget, this is also playing into a very, very low VIX environment. And then all of a sudden, boom, breaks down. All right, so the neat thing about this particular bottoming pattern is that it happens here on the monthly. Actually, it bottomed, let's bring it back here. On Boxing Day in Canada, so December 26th, let's pull up that. So there's December. Again, they sold it right into December. So people thought there was going to be a Santa Claus rally. There was no Santa Claus rally last year. look at the sequence on the daily. Outside bar, right? And down, down, down. As soon as they break above the outside bar high, that means momentum to the downside is gone, and they bought it back. There, on the new week. Okay, that's the new week right there. There is the new quarter. The buyers took advantage of the new quarter right away, and they just kept on going. On the monthly, it looks like this. Inside bar and down. Once this high gets taken out on the monthly, then they're going after that pivot, and ultimately that pivot, and that's what brought us to these all-time highs. But now where are we? Outside bar on the monthly. Trading very, very close to the quarterly open. So this is where, you know, we're in a amber environment now, because we're trading very close to the quarterly open on SPX, but we do have two indices, the Russell and the Dow, who are trading below the quarterly open. And we know that bad things can happen, so we need to be on amber alert here to see, you know, if bigger things can happen. Again, the goal is not to try to predict things, as I've alluded to many times in this presentation. The goal is simply follow price. If you follow price properly, you'll be on the right side of price when things go up, or ultimately when things go down. So to conclude, I'm just going to share a few more areas that I think are worthy of research and some resources for you. So as I mentioned, I think volume would be a very interesting overlay onto the analysis. Difficult to obtain the data though. So the volume would be a very interesting study to overlay on top. Volatility will also be a very interesting stat to begin to measure and to see if, you know, the contractions in volatility have at all a correlation or any kind of factors in the selling. So do lower volatility environments, you know, do they somehow lead to, you know, larger sell-offs? Intraday data, because TradingView does not have the historical intraday data or tick data, we don't get to see the intraday moves. So this would be very interesting to see the actual intraday moves beyond just the daily open, high, low, close. I showed a few, you know, intermarket relationships, but I think time would definitely be worth spent actually looking at each one of these reversals by index to see, you know, which index was leading which one, you know, the reason for that, and to see if there's any clues, because sometimes, you know, the index themselves can give clues, especially to early leadership or late leadership. We're in a situation now where we have kind of mixed leadership, as I mentioned already. You know, SPY and Qs are still trading above their quarterly open, but what happens when all four trade below their quarterly open? Then, you know, that's the kind of relationship you want to be watching for, but then you have that confluence. Market valuations, so understanding perhaps PE ratios across time would be very interesting to see if market valuations play a deterministic role. You know, there's a thing called CAPE, which is cyclically adjusted price to earnings ratios, so that'd be a very interesting measure to overlay. Market internals, things like the NYC tick data I think would be interesting to see if there's actually any divergences. So you might want to see things like the advanced decline line. You know, are leading stocks, are fewer stocks participating in the rallies as we get higher up, and is there any kind of foreshadowing there? Interest rates. So we know the stock market and other financial instruments are very interest rate sensitive. So overlaying perhaps interest rates announcements or actual interest rates themselves, reductions or rises, increases or reductions would be interesting. And finally, another thing that's equities are very exposed to the prices of equities. So what do the markets look like on climbing oil prices or changing commodity prices? Okay. So final slide to give you some resources. Black Swan, an excellent read for folks who want to get in the heads of some of these Black Swan events. You know, history has shown over and over again that we can have these black swans, to the point now where you have to wonder if they're actually black swans at all, or just, you know, a nature of these complex systems. Ubiquity is one of the books I talked about earlier in the presentation. Devil Take the Hindmost, great book, talking about some of the markets, some of the world's bubbles. So I use that heavily on my reference for the 1929 research. First Class Catastrophe, so that's about the 1987 crash. Quants was the 2007 crash, and A Brief History of the 1987 Stock Market Crash, a really good white paper that you can just download for free if you Google it, by Mark Carlson of the Fed. All right, well, that takes us to the end of the presentation. I hope you enjoyed it. I apologize for the amount of time it took, but I'm happy we got through it, and I hope you got a lot out of the presentation. If you have any questions, feel free to reach out to me. Happy to hear your feedback.